accountants of Nigeria. His core competencies include developing, implementing, and operationalizing transfer pricing policies aligned with Nigerian tax laws and OECD guidelines. He's proficient in advising on tax structuring and optimization strategies designed to enhance tax efficiency and commercial viability. His professional experience includes provision of advisory services on transfer pricing compliance, risk identification, documentation review, benchmarking analysis, policy development to ensure conformity with Nigerian regulations and international best practices. He leads engagements that It leads engagements that design tax-efficient group structures and cost allocation methodologies, especially for complex industries such as banking, fintech, multinational financial services group to optimize tax outcomes while maintaining commercial substance. He has also successfully negotiated favorable settlements and clarifies complex tax positions on behalf of clients to secure optimal outcome. He has attended relevant training. He has facilitated several of that. Part of them includes Ernst & Young's transfer pricing audit workshop, March 2018, where over 30 senior tax professionals from leading multinational companies attended. He delivered training on country-by-country reporting regulations and their implications for Nigerian taxpayers, led transfer pricing audits controversy training sessions, equipping over 35 multinational tax teams with practical strategies for managing disputes and navigating audit challenges. He has organized and facilitated several capacity building programs for key Nigerian regulatory and professional bodies, including FIRS, now Revenue Service, Nigeria Revenue Service, National Office of Technology Acquisition and Promotion, Ican, and CITN. Join me in welcoming for today's technical session, Mr. Adefemi Olaore. He will be speaking on on OECD transfer pricing framework and guidelines, contemporary issues, and recent development. Mr. Adefemi Olaore, you have the floor, sir.
Good afternoon, everyone, and thank you very much, Mr. Ishola, for introducing me. Trying to put on my video, but I think I will just proceed. So thank you very much, Mr. Ishola, for introducing me. I would also say a very big thank you to the chairman, standing on existing protocol. It's an honor to be in attendance at this very session, and compliment of the seasons to everyone. So with that, I would say let's go into the technical session for today. Thank you very much. If you could please share the slide and we can start.
Okay, do you want to share from your hand or I should share from here?
I think it would be better if I do that. So let me just.
All right, please go ahead, sir.
Yes. All right, Mr. Ishola, please, can you confirm if you can see my slide on slideshow?
Yes.
Yes, please.
All right, thank you very much. All right, so good afternoon again, everyone. Like the chairman explained to us, today's session would be on the OECD transfer pricing framework and guidelines. right? Speaking on contemporary matters as well as recent development. Now, the chairman had alluded to the fact that this training will be relevant to individuals who manage tax functions for, multinational companies or companies that operate within the group arrangement. Just to add that even if you are not, representing tax functions in your various companies, if you are a student today, the topic would still be relevant to you because transfer pricing involves more than just tax. Transfer pricing is usually relevant to the top line of the company as well as the bottom line. As we go through today's session, you would see why it would apply to everyone in the company. You could be an engineer, for example, and the knowledge of transfer pricing can help manage the profitability of a company, for example. Now, moving on to the snapshot that I'm showing currently, that speaks to what we would be discussing today. We would be speaking as to how the OECD transfer pricing guideline has provided guidance for taxpayers, multinational administrators across the world on how transfer pricing is being implemented across different countries. We would also speak to how it specifically affects Nigeria, because I would say over 90 something percent of the members on this call are basically representing functions in Nigeria. So we'll speak to that as well. And we would ask questions. I expect that the session will be very interactive. So we don't have to wait until the end of the session to take questions. If you have questions, you can raise up your hand and perhaps a co-host would notify me that a hand has been raised so that I can answer those questions, or you could drop a chat in the chat box with your questions. So we basically will be, explaining what the OECD transfer pricing guideline is and why it is, the relevant framework for transfer pricing in Nigeria and across the world. We would also be speaking to how, the local tax authority has been using it, in implementing their rules in Nigeria and across Africa. We would also try to speak on, recent developments arising from BEPS projects and, post-BEPS implementation projects as well. Now, at the end of today's session, my expectation would be that, each and every one of us would be able to explain the OECD transfer pricing guideline as a system that allows us, to bring total processes to play. All right. We would also expect that everyone should understand the areas of the guidelines that have changed over the years. I would also like that, everyone today would be able to examine how these developments, influences the behavior of the Federal Inland Revenue Service, particularly towards audit and, documentation obligations. We would also look at, interpreting OECD concepts within the context of the Nigerian transfer pricing regulations and how, this is being implemented in practice. Now, our content will be guided around 5 pillars. We'll speak to an overview of the OECD transfer pricing guidelines. We would also examine the concept of the arm's length principle and also look at how it is applied in transfer pricing. We would look at contemporary OECD transfer pricing developments and their implementation in Nigeria. We would also speak to key learning points, and I would expect that you would have feedback, particularly on areas that may affect you directly or indirectly. And if time permits us, we'll take a look at 1 or 2 case studies and question and answers. At this point, I would take a very brief pause here, maybe a 30-second pause, and ask the class if there are expectations that we have not already captured in our learning outcomes. You could put it on your chat box. All right. So if if there are no comments in the chat box, I will just move on with our study for today. Moving on to Module 1. Module 1 speaks to the overview of the OECD transfer pricing guideline. Now, we're going to be speaking to what the OECD transfer pricing guideline is. Now, the OECD transfer pricing guideline is basically a collation of several sections that guide the implementation of transfer pricing around the world. Now, before the introduction of the OECD guideline in 1995, tax authorities around the world have focused the application on intercompany transactions by using the arm's length principle, which was provided in Article 9 of the OECD model framework. Now, the OECD model framework is basically on taxation and capital. And that particular section basically requires that if you have a transaction with a member of a group that you are part of, or anyone that could be considered to be related to you, such transactions should be treated as if you were transacting with someone you are not related to. And that is really the principle of arm's length. So the OECD transfer pricing guideline is founded on the arm's length principle that requires that you transact with everyone the same way you would transact as if they were not related to you. Now, you would hear a lot of comments, by certain players in the industry saying, oh, if the OECD transfer pricing guideline provides for the treatment of a transaction in a particular way, the tax authorities should accept it. But that would be very wrong, because although the guideline is like a Bible, right? The way a Bible is to Christians, the way a Quran is to Muslims, transfer pricing guideline is the same, right, to transfer pricing consultants or multinationals that look at, pricing intercompany transactions. Unfortunately, even with that force, it does not have the force of law, because in every jurisdiction where you have transfer pricing, those jurisdictions still have, locally or domesticated laws that guide the framework. Now, a lot of these laws that have been domesticated already, copy the framework from OECD, but the OECD remains secondary because, they are basically referred to for guidance. So you will see typically that, the OECD transfer pricing guideline is being used to explain, policies, particularly in areas where local laws do not cover or where there are ambiguities. So again, I would say, they are widely adopted as persuasive authority by tax administrations and courts, but they do not have the force of law. Transfer pricing guideline basically influences domestic transfer pricing regulations, treaty interpretation, and administrative practices across both OECD and non-OECD countries. Now, we've talked about the OECD. Now, the OECD is basically made up of about 40 countries around the world. So when you hear OECD, not everyone in the world is part of that group. It's basically a group of countries who are considered developed and a few other countries who are developing that have come together to put in, policies that would help manage base erosion, right? And this is mainly focused on helping developing countries manage, their GDP per capita. How do you prevent capital flight? So the OECD frameworks are basically meant to help achieve that goal. But irrespective of the fact that, you are not a member of the OECD, you are not restricted in applying, some of the policies that they have put in place. In practice, the framework basically functions as the global standard for transfer pricing. In fact, in Nigeria, what we've seen is that, taxpayers and tax advisors will typically rely on OECD concepts, to argue their positions during audits. And this is particularly relevant where, the Nigerian TP regulation, for instance, is silent on, specific matters. Now, for those of us that are familiar with the Nigerian TP regulations, they are mostly principle-based. So you won't have examples that cover all scenarios. So you basically have to rely on, frameworks such as the OECD transfer pricing guideline to help understand, your own narrative and argue your context, basically. Now, let's speak to the historical evolution of the OECD transfer pricing guideline. Like I mentioned, the first OECD transfer pricing guideline was enacted or was collated in 1995. But before 1995, there was a huge focus on the arm's length principle. Now, while there was no single document, right, that was largely available to the public, there was that focus on the arm's length principle that the OECD model tax framework provided for. Right? You typically would hear certain things about anti-avoidance strategies. Right? Now, the arm's length principle is basically to help protect or prevent avoidance schemes that companies will typically put in place to ensure that they move profit or they move capital out of developing countries or countries that have high tax rates. Before 1995, laws guiding transfer pricing were largely conceptual. There were no specific guidance that provided clarity on how to treat transactions. But in 1995, the first ever OECD transfer pricing guideline was introduced, and it primarily focused on the different methodologies on how to assess transactions from a transfer pricing perspective. Now, between 1995 and 2010, which was a 15-year period, there were a lot of issues on, how tax authorities were interpreting some of the provisions. So in 2010, a new guideline was introduced. Now, this guideline basically provided refined clarity on the use of transactional profit methods. Now, I won't speak so much on the specific method because we don't have, that luxury of time today, but just for your high level understanding, we'll cover the relevant bits. But the 2010 version basically introduced clarity on how to use transactional profit methods, particularly the TNMM. Now, TNMM basically means the transactional net margin method, and it is commonly referred to as the most popular transfer pricing methodology we have. Now, the 2010 version was basically saying you are allowed to use the TNMM, particularly in areas where there is lack of information or you cannot even rely on the information that is available. Now, in 2015, the OECD came together and working with other developing countries that were not part of the OECD, they formed a group that we typically refer to as the OECD/G20 group. And they came up with a BEPS framework. Now, in a very short while, we'll speak more about this BEPS framework. But the BEPS framework was basically to manage base erosion and profit shifting, particularly from developing countries. So in 2017, an updated guideline was released. Now, this particular guideline basically incorporated action plans from the BEPS project that I think the primary focus was basically to align profit with value creation. Now, what that version did was to say, if you're not creating value in a particular country, then that country does not have the right, to tax whatever income that is being generated. And you would agree with me that, this makes sense, particularly with the influx of, investment in Africa. And at the end of the day, you would query why, GDP per capita was still low. And we'll get into this very shortly. Now, moving on to 2022. Now, between 2017 and 2022, the OECD, in trying to manage the gaps, from the first BEPS framework, introduced a couple of notices or circular that, was explaining changes, around the global tax landscape. And they introduced another version in 2022 that basically consolidated on some of these things. For example, there were detailed rules around risk control, how to price financial transactions, and intangible. And from 2022 to date, there have been several supplementary guidance that, have come particularly to manage the challenges of taxing the digital economy. I'm sure most of us here are familiar with, the significant economic presence framework, which we'll get to in a very short while. And between 1995 and today, these are the changes we've seen. Now, the expectation is that a new transfer pricing guideline would be released, and we expect that this will be published early next year. Which is just a few days or a few months away from today. But generally and overall, what what we've seen over the years is basically a move from rule-based pricing to a substance-driven framework. So rather than relying on the form of your transactions to determine whether you've priced your transactions in an arm's length manner, tax authorities around the world are primarily looking at, the substance of your transaction, whether value has been created in that particular jurisdiction. Now that takes us to our next slide, our next module that speaks to the arm's length principle and how it is applied in transfer pricing. Now, we have talked about the arm's length principle already, right? I mean, the principle is basically saying if you are negotiating a price with someone that you are related to, you could be related to an entity either by management, control, ownership, or you could have a situation where one entity has significant influence over two other entities. So if those other entities transact with each other, such transaction will fall under the scope of transfer pricing. So at the end of the day, the principle is, have you priced your transaction in a manner that entities that have no prior relationship or prior knowledge of each other would price? That is what the arm's length principle is trying to, manage. Now, the arm's length standard will typically tell you, I am only relevant to the extent that profit is attributed unfairly, right? So at the end of the day, what the arm's length principle is trying to do is to ensure that when profit is earned in a particular location, it is attributed in a manner that is considered fair and reasonable, to the extent that value has been created by that company. Now, we'll speak to how the arm's length principle is typically applied, right? People have different versions of opinions, right, around how you typically would apply arm's length principle. But at the end of the day, you cannot always compare apple for apple, right? There are a couple of factors that you need to take into consideration when applying the arm's length principle. Remember that we said the arm's length principle is basically to keep related parties at arm's length when you are dealing with them. At the end of the day, when applying the arm's length principle, you need to ensure that the transaction that you are comparing, right, with in a third-party market is exactly the same. You cannot compare the price of an orange with the price of an apple. So you need to make sure that if you are comparing a product, the product is exactly the same with the product that is being priced in a third-party scenario. If you are comparing a service, you also need to ensure that the service is the same or similar to what is being priced in a third-party scenario. Now, you also need to ensure that the economic circumstance of the entities that you are comparing are the same. It will be unreasonable to compare an entity that provides services in Nigeria to another entity that provides the same services in the US, because the economic circumstances of these two companies are different. Lastly, because of the difficulty in obtaining information to ensure accurate comparability, you need to always make room for adjustment, because there are instances where you are not able to get relevant data. So you need to make sure whatever data you are using is adjusted to eliminate differences that may arise, as a result of economic circumstances or the conditions of the comparability or the comparables that you have at that time. Now, on my slide, I'm showing a chart that speaks to the step-by-step application. We are not going to speak too deeply on this, but I will focus on step one, because step one is usually the most important step. Now, we have two steps generally when we speak to the application of the arm's length principle. Step one is basically focused on delineation of transactions. Step two is focused on benchmarking. Now, step two is basically on speaking to how you price your transaction. But remember that before you speak to how you price your transaction, you need to ensure that your transactions have been delineated properly, such that you will be comparing apple for apple. Now, before you do that, the first thing you need to do is to ensure that whatever third-party comparables you are looking at operate in the same industry. So you need to ensure that you conduct a broad-based analysis that covers both the company's principal activity as well as the industry that the company operates in. That is usually the first step to ensure that your comparables would be the same. If you don't ensure that the industry analysis is correct, then you most likely would not be comparing apple for apple. Now, after you do that, you also need to identify certain economically relevant characteristics or comparability factors. Now, we are going to be speaking to the 5 comparability factors that the OECD transfer pricing guideline prescribes very shortly. But you need to identify those factors. Otherwise, you would not be able to compare whatever transaction you are looking at in a reasonable manner. Now, amongst other things, you have to perform a functional analysis. Now, a functional analysis is basically an assessment of the functions performed, risk assumed, and assets employed by counterparties to a transaction. So if you have 2 entities engaging with each other, you need to make sure that you independently analyze their contribution to that transaction. Because guess what? At the end of the day, that would determine, how you compensate the service provider. It is very important. Now, speaking to the comparability analysis, for those of us that are familiar with the OECD transfer pricing guideline, if you go to paragraph 1.36, you would see that there are 5 factors that we must all align with for us to ensure that we are comparing apple for apple. Now, the Nigerian TP regulation has also adopted the same 5 pillars. So maybe I should also mention that to a very large extent, there is no significant difference between the Nigerian TP regulation and what we have in the OECD transfer pricing framework. So from what we've seen, if you do anything that is aligned with the OECD TP guideline, you most likely would be found, not wanting, from a Nigerian perspective, because most of the provisions are aligned. Now, back to the topic on comparability analysis. Like I said, there are 5 pillars that you must, adhere to. The first area is to ensure that the characteristics of property being transferred or the services provided are the same, right? For example, oil is a product that is in abundance in Nigeria. You cannot compare the sale of oil, right, by a Nigerian company, for example, to sale of oil to a company, to a company in a country that does not produce oil. So availability and volume of supply is a very key factor. So you need to look at that to ensure that, they are operating in similar economic circumstances. You also need to look at whether the services, for example, that you are providing or you are receiving is a routine service or it is non-routine. Now, if it is a routine service, for example, it means you can easily get a replacement to provide that same service to you. So that means you have the capacity to negotiate whatever price that you are being offered more compared to when you are receiving a non-routine service. A non-routine service is a service that is not easily accessible. So most times you would have a monopolist, providing that particular service or selling that particular product. So you need to be sure in delineating that transaction by checking out whether it is a routine product or non-routine product or a routine service or non-routine service. Now, the next comparability factor will be the contractual terms of the transaction. You need to make sure that the contractual terms of the tested transaction is the same as the contractual terms of the comparable transactions that you are looking at. If I enter into an agreement with my related party, for example, to sell Apple, and I want to compare, the pricing of that transaction with another transaction I have with a third party, I need to make sure that I have not, for example, given one of these entities a credit sale term, or any term that allows, one of these entities to enjoy favorable, either favorable payment or favorable delivery term, because it will not be equal anymore. It won't be similar. So we need to ensure that the contractual terms are very similar. The next would be the functional analysis, which I talked about earlier. You need to be sure that the delineation of functions, asset, and risk is properly carried out. You need to ensure whether the function you're looking at is principal, whether it is routine. You also need to ensure whether the assets would fall under the categories of tangible or intangible assets. Then you also need to look at the risk. Is this a high risk transaction or low risk transactions to the counterparties involved? The next pillar is the most popular, particularly for Nigerian companies, the economic circumstances of the parties. The geographic location is very important. Then the availability of competition is also very key. Like I mentioned, if you are a monopolist that operates in a market, it might be very difficult to get comparables to benchmark your returns. So further adjustments will need to be done to ensure that you are comparing apple for apple. Lastly, we have business strategies that are pursued by the parties involved. Now, a very good example would be a new entrant to the agricultural market. If I'm coming new into a market that is, for example, already saturated, there is no way I would be able to establish a very good market share if I don't decide maybe to sell at a lower price compared to my competitors. So I could say, oh, I would sell at a lower price so that I can increase my market capitalization. Now, that might not result in more profit for me in the short term, but in the long run, that might help me. So if you are comparing a company with another company in an industry, you need to be sure that they have similar strategies. Otherwise, their profitability would never be the same, or at least be comparable. So it's very important we understand these 5 pillars. Again, I would say characteristics of the transaction, contractual terms, functional analysis, economic circumstance, and business strategy. Now, still speaking on the arm's length pricing, particularly on how it is being implemented in Nigeria. The arm's length pricing is basically based on a range because it tells you that given the difficulty in ensuring ensuring objectivity or precision for transactions, you necessarily do not have to, conform to a particular point. So the transfer pricing guideline, the OECD transfer pricing guideline allows you to price your transaction within a particular range. Now that range is typically referred to as the arm's length range. Now in 2017, the transfer pricing guideline introduced a provision that limited what we today know as the arm's length range. So unlike before, where the arm's length range was the full range, which is the point from 0 to 100, in 2017, they restricted that arm's length range to a point between the 25th percentile and the 75th percentile. So what the Nigerian transfer pricing regulation in 2018 did was to also include that in their own regulations. So what they've done basically is to limit how much you can consider as reasonable pricing. That is what you typically would see in practice in Nigeria because the FRS typically applies this as well. Now, what we typically see in practice is, the tax authority might also want to argue that for years prior to 2018, the arm's length range should also be the interquartile range. But, given that the law was not implemented during those periods, and the fact that a law that was implemented in 2018 cannot be applied retrospectively, one can always argue that the acceptable range should be the full range, particularly for periods starting from 2013 to 2018. Now, in Nigeria today, we also align with the measures of central tendency for determining what we consider the arm's length range. So you can calculate it using your mean, your median, or your weighted average. So these are all aligned with what the OECD transfer pricing guideline would recommend to us. Now, maybe just to get a breather, I have a quick case study that I would like us to review and hopefully get an answer from the audience. So we have a Nigerian company called Box Phone Merit Holdings. That company is engaged in the purchase of raw materials from its related entity in the United Arab Emirates. Now, the United Arab Emirates entity, BMH UAE, charges a markup of 8% on the cost of product sold to BMH Nigeria. Now, the question here is, would the 8% markup charged by BMH UAE fall within the arm's length range and be considered consistent with the arm's length principle? I just need one person to give me an answer. Unfortunately, I can't see the chat box, but I will need assistance from any of my co-hosts in case there's an answer being typed out.
Sorry, the question again, sir.
Okay, so I have the question on the board. The question is whether the 8% markup, that is charged by BMH UAE is in line with the arm's length principle. So remember I talked about the arm's length range currently being the interquartile range, which is the range between the lower quartile and the upper quartile, which is the 25th percentile and the 75th percentile. So if I'm being charged 8%, would 8% be considered in line with the arm's length principle? Okay, I see an answer from Adedokun Nuruddin, and he says no. So I would agree with his answer, and he has further explained that 8% is far lower than 25%. Okay, so I would agree with your answer that it should be no, but it would be because 8% is actually higher than the maximum limit that the law allows you to charge. Remember that the law allows you to charge a point between 3.90 and 7.83. And that is also what the OECD transfer pricing guideline prescribes. So if you charge 8%, given that 8% is higher than 7.83, most likely you would face pushback from the tax authorities. And if you are looking at it from an arm's length principle standpoint, that is not consistent with what the policy prescribes. So 8% is definitely higher than the upper quartile, which is the maximum limit. So your transaction would definitely not be in line with the arm's length principle. I hope that is clear to everyone. All right, so moving on to our next module, which will be much more relatable. Here we'll be speaking on the contemporary OECD transfer pricing developments and their implementation in Nigeria. Now, for those of us that operate within tax functions or even accounting functions within our various organizations, you most likely will be familiar with the base erosion profit shifting project. Now, this is a topic that became popular sometime around 2015. Now, what does base erosion profit shifting mean? These are basically avoidance strategies that multinational companies, have put in place to basically exploit loopholes within, tax laws around the world, that allows them to shift profits to low or no tax locations, particularly where there is little or no substance. So you must have heard about tax havens around the world. What companies would do is to set up holdcos around those areas, or they would have companies that engage in trading operate from those jurisdictions. So these types of arrangements have over the years been used as tax avoidance strategies, to move profit around. Now, to be clear, tax avoidance is not illegal, right? Tax evasion is actually illegal, but there are instances where aggressive tax avoidance scheme, could be deemed to be tax evasion, right? There's a very thin line between tax evasion and tax avoidance. And we've seen in that, in practice, companies have, aggressively entered into tax avoidance strategies that would allow, them take out money out of Nigeria. And you would agree with me that in the last 2 years, sorry, is that a question for me?
No, please go ahead.
Okay. All right. Thank you. So you would agree with me that in the last 2-3 years, the federal government's attention has shifted from oil as the major revenue bringer to tax. So there's been a renewed focus on transfer pricing as a way to manage or restrict how much capital or profit you can take out of Nigeria. And very soon we'll speak to how, the Nigerian government has implemented BEPS in Nigeria. As we had earlier, noted, the goal of BEPS is for countries to agree to a unified plan for international taxation. So, like I mentioned, the OECD as well as other countries around the world, particularly the US, came together to agree on certain action plans that would help limit, base erosion of their economy. And this was also done for the benefit of developing countries in mind, with some developed countries that would also, benefit from it as well. Now, I think the primary objective really was to eliminate double non-taxation. Double non-taxation is a scenario where income is derived from a country and repatriated to another country, but that income is not taxed in either country. So one of the objectives of BEPS is to eliminate double non-taxation. Then they also wanted to eliminate, instances of having stateless income, where you derive revenue in one country, but because you do not have a presence in that country would not have, the taxing rights over that income. And in a bid to do that, they introduced a framework that basically provided 15 action plans. And the next page would speak to, these 15 action plans. Now, these 15 action plans are broken down into 3 areas: coherence, substance, and transparency. But because of time, I would speak to, the minimum requirements that Nigeria, as a member of the BEPS framework, was expected to implement. I can confirm to you that as at 2016, when Nigeria joined that framework, these minimum requirements have been implemented. So for ease of reference, I've highlighted the minimum requirements in red. You have Action 5, which is basically speaking to harmful tax practices. This is basically putting certain provisions in our law to restrict aggressive tax avoidance. Now, one of the examples I would say was introduced through the Finance Act 2019, which was the introduction of the interest deductibility limit, right? Which was basically to limit how much you can take as tax deduction on interest payments on foreign loans. You also have Action 6, which is basically preventing tax treaty abuse. On this one, I would say there were a couple of circulars that the FIS released that, very clearly the requirement for you to meet, for you to enjoy, benefits from tax treaties. You have Action 13, which is focused on transfer pricing documentation and country by country reporting. Action 13 is basically saying there is now a 3-tiered documentation that you are expected to maintain: the master file, the transfer pricing local file, as well as the country by country reporting. Then you have Action 14. Action 14 is basically speaking to dispute resolution, which is aimed at managing, the rights of taxpayers as well. And since that time, you will see that the Nigerian government has introduced the MAP framework, as well as, the APA, which would go a long way in minimizing disputes particularly after audit. Now, aside these four, if we had time, we would have gone through the rest, but I can tell you for free that the federal government of Nigeria has somehow managed to implement all of them. But what they've done is basically to introduce local legislations to ensure that the same objectives are, achieved. For example, Action 1, which is focused on digital economy. What the Nigerian government did was in 2020 February, they introduced the Significant Economic Presence Order, which was basically to provide guidance and rules for taxing companies that provided digital activities or services to Nigerian users, right? We've talked about the interest deduction, which is achieved through the 30% limitation, 30% of EBITDA limitation on foreign interest payments. Then you have Action 8 to 10 that focuses on transfer pricing. So in a way, the federal government of Nigeria through the FRS has achieved, almost full completion in, ensuring that the BEPS action plans have been legislated into our laws. Very quickly, I would speak to the practical realities around the implementation of BEPS so far. Now, the introduction of BEPS into our Nigerian framework has changed the conversations, particularly during audits. And I've tried to show this across 4 transactions. So these are typical high-risk transactions that you might face if you're under audit by the FRS. Now, transfer pricing audits will typically happen differently from your tax audit. So if you have faced a transfer pricing audit before, you might be able to relate. Now, for intangibles, unlike before, where the focus would just be on the pricing, the tax authority is now interested in who owns, such intangible. So they will try to make that distinction between legal ownership and economic ownership, right? So they want to know who assumes the DEMPI functions and risk. Now, when I say DEMPI is an acronym for development, enhancement, maintenance, protection, and exploitation. So the expectation is that whoever performs the DEMPI functions, as well as assumes the DEMPI risk, is the true owner of the intangible. So this helps to limit the placements of, owners of intangibles in jurisdictions that do not require substance, right? So, this has actually worked. From my experience so far with the FRS under audits, the fact that these questions will come up it has made companies to restructure, their operations, basically have more substance in place. Now, other questions under intangibles would also be around the entrepreneurial returns. Would there be a requirement to have maybe the Nigerian licensee, for example, share in that return? Over a while, the FRS will typically argue that Nigeria is a big market with over 200 people, that even without marketing, there would be a market for that product. So if you are making a huge percentage of your group revenue from Nigeria, the expectation is that the Nigerian entity should be expected to share in the residual profits from that transaction. So we typically would see that in discussions, and this is because of the BEPS framework. They would also want to know if Nigerian entity develops strategies or just executes. They would also be interested in whether the licensee, who most likely will be in Nigeria, spends on advertising, marketing, and promotion. So the question is, if I have a trademark, for example, from my foreign affiliate, that is basically to help me market my product, then why do I need to spend so much on, AMP? I see Tunde Oladipo has his hands up. Please, you can speak on. Hi, Tunde, I can see you have your hands up. Can you unmute and speak?
I think we should continue once he has it so that we can
Okay.
be able to.
All right. So we have similar questions, across other transactions. Maybe I will just speak on the loan transaction and move on to the next slide because of time. For loan transactions, we have increased scrutiny on related party loans, a focus on thin capitalization and interest deductibility. Now, bear in mind that Nigeria does not currently have, a specific thin capitalization rule. However, what they've done is to use the interest deductibility cap to manage, how thinly capitalized companies, are. And, based on the expected introduction of the Nigerian Tax Act, you would see that that deductibility limit has been expanded to also cover local loan transactions. There's also questions around, who you should be testing in a loan transaction. Should you be testing the lender or should you be testing the borrower? So these are things that would come up. And the reason it would come up is because, companies will typically argue that, given the high risk nature of the Nigerian environment, it is almost impossible for you to get a loan below 30%. Now, the FRS, on the other hand, would say, would companies openly come and invest in a high risk situation? So these are all contextual, arguments that can be made, and to give rise to these questions. Then I think lastly and very importantly, is the loan to the Nigerian entity an actual loan or an equity? So there are usually conversations that might even allow the tax authority recharacterize your loans, particularly if you do not meet specific requirements that a loan should typically have. Now, for this one, the OECD in 2019, and also I think consolidated it in 2022, introduced a framework that provides for specific minimum requirements that your loan agreement should have, or the substance of your loan should have. And typically what I've seen under audit is FRS would use the absence of any of those minimum requirements to argue that your loan is indeed an equity, irrespective of the fact that, there was actual inflow of funds. But again, like I would say, these are all argumentative. Now, I'm sure these slides will be provided to you, so I would skip the rest, but they are basically questions that would typically come up under audits as a result of the implementation of the BEPS project in Nigeria. Now, moving on to a very important topic, which is also as a result of the BEPS project, digital economy and the emerging challenges. Now, I walked us through 15 action plans, right? And those action plans are typically referred to as BEPS 1.0, right? That was the maiden BEPS project that was implemented in 2015. Now, over the years, tax authorities around the world have seen limitations, from that project. So what they've done is to come together again and come up with a secondary project known as BEPS 2.0. Now, BEPS 2.0 is basically focused on the taxation of the digital economy. And in doing that, they've introduced, two pillars. Pillar one is basically going to be speaking to the reallocation of profits of an M&A in jurisdiction where they do not have physical presence, but they have, marketing and distribution activities. Now, this is not different from what we currently have in Nigeria today, that is referred to as the significant economic presence order. Now, instead of implementing Pillar 1 in Nigeria, what federal government has done is basically to implement its own version of Pillar 1. Now, remember that Nigeria is limited by the fact that we don't have so many multinationals operating in Nigeria. So if they were to follow, the wordings of some of these pillars verbatim, they might lose a lot of revenue. So what federal government has done is basically to still apply these pillars, but to do it in a manner that will not affect, what they currently are getting as revenue, or affect the current tax base. The second pillar is the global minimum effective tax rate. I'm sure this is popular because of the Nigerian Tax Act that will be coming on in a couple of days. I think this particular matter has been overflogged, but what the Nigerian government has done here is basically to implement a global minimum effective tax rate for local companies, right? And the reason they have not applied Pillar 2 as it should be, as prescribed by the OECD, is because we do not have a lot of Nigerian headquartered businesses. So to manage the losses that they might get from the implementation of this in other countries, they've also done something similar for domestic companies, which is to apply a 15% minimum effective tax rate as against, the previous minimum tax that was 0.5% of gross turnover. Very quickly, I'll move on to key learning points. Today, we've learned that the OECD transfer pricing guidelines remain the primary global reference point. So even though they do not have the force of law, I can confirm to you that heavy reference is being made to the OECD at almost every point because it is a much more complete reference than even the laws you have across the world. We have also learned that the BEPS action plans was basically implemented to eliminate profit allocation that do not have economic activity attributed, to the service providers. As a drawdown from that, we've seen that greater emphasis is placed on people function, control, and substance. Unlike before, where you look at the form of the transaction and you use that to build the pricing. Now, the tax authorities around the world want to see that people who are actually performing these functions, the companies that are earning the returns have appropriate control over risk and their substance as well. We've also seen that contractual allocation that are not supported by real activity will be discarded. We talked about, potential recharacterization of loans to equity, right? So we've seen transactions like that always recharacterized because there's no substance to them. Now, the result of this implementation, like I mentioned, right, has led to increased transfer pricing audit activities, particularly in Nigeria. We've also seen that there've been improvement in documentation quality because taxpayers are beginning to realize that the quality of your documentation almost directly influences the progress of your audit. And lastly, I would say the greatest learning point from the implementation of the BEPS project is the fact that transfer pricing should not just be seen as a tax area, right? It is much more than tax. It should be seen as an area that strategy should be built around. It's not just about filing. It's not just about preparing transfer pricing documentation, but at every meeting that involves strategy, transfer pricing should also be considered. At this point, I would move on to case studies or we'll take questions. So maybe at this point, I can take the question from my colleague that had his hands up. I can also take questions from every other person in the room. But I think while we are waiting for that, okay, Folashade, I see your hands up. Can you please ask your question? You can put it on the chat box or unmute your mic.
Good afternoon, everybody. Good afternoon, sir. Thank you for the wonderful presentation so far. So please, may I have a question? So I have a client in the hospitality industry that uses the franchise of a foreign entity, and they pay management fee for using that franchise. So I just want to ask, by the payment of that management fee, is it making the foreign company related to that Nigeria hospitality industry? I don't know if you understand my question, sir.
Yes, I do.
Okay.
So yeah, so let me take that, and I can take others after. So relationship for transfer pricing purpose is typically defined by 3 pillars. So you're either related by ownership, which could be direct or indirect. So by direct, I mean whoever you are transacting with is a shareholder,
Yes.
By indirect, whoever you are transacting with is either a beneficial owner or someone related to the shareholder of the company in Nigeria. That is one pillar, ownership. Second pillar would be management. If you transact with a company that has common management, let's say you have a director in company A and that individual is also a director in company B, then one can argue that that individual in his capacity can influence the pricing of the transaction. Then that will be considered a transaction that will fall, under the scope of transfer pricing. Now, thirdly, you have significant influence. If you are a third party that is able to control or manage the financial, economic, or commercial decisions of two other companies, then the transaction between the two other companies will be deemed to be a controlled transaction. Now, these are broad definitions that guide whether or not entities that transact with each other are related. So the fact that you have a transaction that falls into different category types does not necessarily make it a related party transaction. So we need to look at whether there's relationship by ownership, management, or significant influence. Now let's not forget that you could also be related through other means, right? Sibling relationships would make a transaction related, for example, spousal relationship as well. If you are married and your husband owns a company, if your company interacts with your husband's company, then that transaction will be considered a controlled transaction, and such transaction will be required to be priced at arm's length. So if I was to apply this to your example, to the extent that there is no relationship between the franchisor and the franchisee, then there should be no need to bring in transfer pricing or require an arm's length pricing, because that transaction would naturally be deemed an arm's length transaction because they are both third parties. I don't know if that answers your question.
Yeah, thank you very much for that answer, because we had a tax audit and that issue came up. And FRS was referring us to Section 27G of CITA, which is talking about interest payments to related party thereof related to TP regulation. And when you read the TP regulation, it's saying that we should restrict the management fee to 5% of IDA or thereabouts. So this argument also came up, and that's why I was wondering, if we say by management, there is no management, they are not related by management. Okay, but they're arguing that maybe by influence, because the franchise of that the name of that foreign entity is influencing their sales here in Nigeria. That was the argument FRS was putting up, to say by influence.
Yes. So what I would say is there are several instances where one can argue, right? If a company has significant influence over your commercial decisions, your financial decisions, then one can argue that such transactions should be deemed as controlled. So if 100% or 90% of the Nigerian company's sales, for example,
if Dota are giving them certain percentage of sales and the likes, why should FRS still restrict the management fee that is paid annually? That means
okay. So this is a very interesting question,
and
I'm glad you asked it.
The franchise.
So let me explain that. Now, NOTAP and the tax authorities are two different regulatory bodies with two different objectives, right? NOTAP is primarily responsible for managing the inflow of foreign technology into Nigeria. So for the time being, their purpose is really to manage the outflow of foreign exchange. Now, remember that Nigeria currently is struggling with, supply of foreign exchange. So their job really is to limit how much foreign exchange you take out, particularly if you can provide or if you can obtain such services in Nigeria. Now, the FIRS is not disputing what NOTAP has approved. FIRS is basically saying, based on the tax law, I'm going to restrict whatever you are allowed whatever you want to, allow for tax deduction. So irrespective of what the FIRS does, you can still pay out what notable has approved, right? So again, we've been having, deliberations with both regulators to ensure consistency. And until 2018, there used to be some sort of alignment because the TP regulation of 2012 had what we call a safe harbor, which means if I have priced a transaction based on NOTAP approval, then such transaction should be fine. But based on the 2018 regulation, that safe harbor provision was expunged. So currently, you need to prove your case using transfer pricing, right, to ensure that whatever deduction or provision you've made for that transaction is not reduced under audit. Yeah, so that would be my submission on that.
Thank you very much, sir.
Thank you. Do I have questions from anyone else? I know Mr. Tunde had his hands up. I don't know if he wants to take his question now. Otherwise, I see we are out of time, so I would maybe hand over to my technical secretary. Okay, yeah, Mr. Tunde, I can see your hands up. Can you please ask us your question?
Okay, let's assume that probably it's just results for other things.
Mr. Olubodun, I
Thank
can't
you so much.
hear Tunde. I don't know if you can hear
Sir,
him.
So Ladipo is on now. We can hear him now.
Yes, yes. I think the question I want to ask has been answered. She has asked the question, so I got the clarification now. Thank you.
All right. Thank you very much.
Thank you so much.
So to my co-host, I would hand over the mic at this point. I think we've been able to answer questions that are critical to real operations. So at this point, I would say thank you very much for giving me the opportunity to share my knowledge on transfer pricing with you. And it's been a good gathering, I would say. And I'm looking forward to other sessions with IGDF. Thank you very much.
Mr. Oshulan, are you available, or the vice chairman should take over because we need to wrap up? Thank you so very much, Mr. Olare, for the well-detailed and engaging presentation. Thank you. We appreciate. Vice Chairman, sir. Is Mr. Olubodun on?
Okay, I think he's having some issues with his connection. Thank you, Mr. Olaore. Quite appreciated. We want to say a very big thank you on behalf of the management and leadership and the entire membership of the district. We want to say thank you for honoring our invitation, and it was quite an engaging session. It was back to class for some of us, and it was quite insightful. And we want to thank you for stopping by to share with us. I hope that subsequently we'll look forward to more collaboration with you as regards issues like this. On behalf of the district, we don't usually, we cannot pay you for what you have done for us. The value cannot be estimated, but just as a memorabilia and just as a token of show of appreciation and love for you, we have a token of this plaque that I'm displaying, and this will be passed across to you. The physical plaque will get to your office, in due course. And we want to say thank you very much and God bless you. Real good, richly. Thanks, my chairman.
Thank you. Vice Chairman, please, let's move to recognition so we can quickly wrap up.
Okay, so to everyone that is joining us for